Hello everyone, welcome back to Just Invest Today. And in today's video, we are talking about Alibaba and how I overpaid for Alibaba at the time. And this was back in 2020 at the end of 2021. And yes, I overpaid for Alibaba. And I think a lot of us did because the information that we had at the time was wrong. It wasn't right because we honestly used the past data for Alibaba, even though it was still a maturing company. Hopefully it can continue its growth going into the future. As we know, cloud is going to take up hopefully a big portion of their revenue, and that will improve their margins like crazy because we've seen Alibaba's margins have been going down and down and down year after year because they're doing strategic things with their money. They're getting into Taobao deals, community buying, and that's all affecting margins. But it's growing the top line like crazy, but that's kind of the lower tier cities where people aren't spending as much and they're not getting as many products, so the margins are kind of taking a hit. They're investing in a lot of international companies like Lazada, like Trendable, and they even had a company in Pakistan, an e-commerce company there. So we're seeing why their margins are being affected. But honestly, this is all creating a lot of value for Alibaba. So this can all be seen as a very positive thing. But we don't see this in the short term right now because it's getting hit. It's hitting the margins, it's hitting the net income. But in the long term, if they do all the right things and we can see the positive coming out of these businesses as they start generating positive income from those businesses, because right now they're still losing money, even though cloud did generate its first profit, which is huge. Even though it was an adjusted EBITDA margin, it's still seeing signs of improvement, and that's with the huge macro headwind. So we can kind of see what's going on with Alibaba. But even after all that, and I still see a strong future for Alibaba, I still overpaid because we were using 2020, 2021 old growth rates. Yeah, man, we've seen Alibaba growing 25%, 30%, top line, bottom line, everything going smooth until the crackdown. And I thought the crackdown was a short-term issue. It still is a short-term issue. As you can kind of see, the regulatory headwind is kind of moving over. It's starting to smooth out a little bit better, but still, Alibaba will not go back to those crazy growth rates of 20%, 15%, whatever it is. I don't believe that they can generate that same amount of net income that it was doing before because it was crazy in the last 5 to 10 years. So going out, I'm projecting more 10% conservatively, but I wasn't doing that back in 2020 and 2021. So that's why I paid a too high of a price. If we are projecting out for Alibaba just on a discounted cash flow rate, I had earnings at $8.49 for 2021, and if I'm growing that 11% and I want a discount rate around 15%, or I want my returns to be around 15%, that's how I look at it, and I sell it at a 22 PE into the future 10 years out, I'm getting around like $131, $141 around that price for the real intrinsic value. But if I use a discount rate of around 8%, 9%, it's more in line of 160 to 170 intrinsic value. Still, I paid around 180, 190 for Alibaba, so I still paid at too high of a price if I'm growing this company out like 11% out into the future. But all of this, even when I paid this high price, I overpaid for Alibaba, I still believe in the business because, man, they're doing so many things. There's still time for Alibaba to still be a good stock to own just because the future is so bright for Alibaba. Even though the company is still maturing, I still believe there's a huge amount of growth in front of it. So Warren Buffett always says the time is the friend of a wonderful business. So for me, actually overpaying for the business, it doesn't really matter as time goes on, as long as Alibaba can hold its dominant position in the e-commerce sector, it doesn't matter because over that 5-year, over that 10-year span, if Alibaba does what it's supposed to do, because it wants to be a company for 102 years. That's what it says in its annual reports. It wants to sustain that growth, and I can honestly believe that for Alibaba, and it's doing all the right things to provide a lot of value for its customers going to the omni-channel route, putting a lot of distributions, a lot of fulfillment centers, all of that stuff. They're going into that sector and they're being more efficient. Man, I can see this business still being effective down the road. So even though I pay this price, it doesn't matter in the long term for this business. And I can still see this business growing out to 200 to 250, 300 maybe into the future, maybe 5, 10 years, 15 years out. So my returns for Alibaba might not be the same as I projected when I first bought it around 180, 190. I'm still projecting hopefully to get at least a 10% return, 8 to 9% return, which is still strong in my opinion. But that might not be strong for the risk I'm taking because it's still a Chinese company. So guys, tell me what you think about this video. Did I overpay for Alibaba? Do you still think Alibaba can go to $300, $400, $500 a share projecting out? What are your thoughts about Alibaba? Please leave a comment down below, subscribe to my channel, and I'll get back to you in the next video.